what extent the deductions we will not be able to get, what are all the various provisions with regarding to on the provisions, there is so much of confusion whether all the provisions are deductible or not. So we are going to discuss on the deductions, then GAAR on the exempt person. My first question to Amit. See, the thing is, everybody is talking about provisions. Earlier, in order for the company, they can decide what is the bottom line. Then if need be, they'll add additional provisions, whatever it is, okay, so that they can find, okay, whatever is the bottom line depends upon that, they increase the provisions, whether it's a bad debt provision or any other provision, accruals or those things. With regarding to the corporate tax, is there any clear guideline with regarding to the provisions, to what extent they can make it, whether the, and is there any guidelines for that?
Thank you, Mr. Krishnan. So I'll give this answer considering what is there in the corporate tax law of UAE, and yes, what is there with respect to international taxation, how it is being treated around the globe. So first, when we talk about the UAE corporate tax law, when we go through with the corporate tax law, where it's clearly mentioned that deduction on the expenditure shall be allowed on the expenses which is incurred for the taxable business, for undertaking the activities, business activities. So word stress is given on the incurred. Even though in a general balance, yes, I can say that what we have incurred, that should be only allowed as deduction. So all the provisions should not be allowed. But when we check the different laws around the globe, they have also defined the word incurred. Incurred is something that actually been spent at a particular point of time, or has a defined certainty with respect to certain conditions. Like if I talk about provision for gratuity, in India, provision for gratuity, when it is made for the approved fund, it is allowed as a deduction. However, for unapproved fund, it is not allowed. On the other hand, when we say the provision for expenses, so in India itself, there are so many case studies are there where the decisions have been given by the Supreme Court even, where it's saying that expenditures which has been incurred and has been ascertained on the basis of the information available, even though the bills were not been received by the end of the year, still it should be allowed as expenses. No, it should not be denied. Moreover, if we provision with respect to particularly on the provision for debts, doubtful debts, provision for obsolescence of stock. So when we take the, I would say, go to the provision that is there in certain countries of Europe, there the provision, or they don't even consider this provision for stock, or I would say provision for stock obsolescence as a provision, because there is no contingency. They just mention it as an impairment allowance. So impairment allowance is not considered as a deductible expense. So from there it's very clear, like if we take the understand the facts or what is going on in the tax around the globe, then yes, provision for debtors and stock obsolescence should not be allowed. If I refer the European tax law, if I take certain things from Indian tax law, yes, what a provision I am preparing for the expenses for which I can ascertain the amount, that should be allowed.
Okay. Yeah, the provision for doubtful debt is always a big concern. Basically, when they say that, okay, you follow the IFRS standard, so everybody thinks that provision for doubtful debts can be allowed, but actually it is not allowed. So they have to be careful when you are creating a provision. Extending this question to you, Dipesh, see, with regarding to the banking and insurance sector, there are various countries have provisions which are allowed to be deducted. So in UAE, there is no clarity. So far, I believe there is no clarity on that. Can you elaborate? Can you expect any cabinet decision in this record, whether for the industry, for the insurance and banking industry, what are the provisions which can be allowed considering the global scenario?
No, I think fair question. You know, by extending the argument that we had on provisions, ideally that's going to be one of the biggest items when you're doing a computation, right? And when we're talking about banking and insurance specifically, provisions are then bucketed into two items. Broadly, one is management decided, management estimated provisions. And there the argument for all the companies would remain the same. The larger question comes is, you know, if a law is mandating to create a specific provision for like, provision for an NPA that the bank would generally have, how do you kind of treat it? Do you still live with a kind of uncertainty, and how do you kind of look at those kind of provisions? Maybe there, you can, as on date, there may be no guidance on the law, but kind of interpreting it, you can also have one viewpoint or one thought to say, if something which is mandated by the law, it becomes your real business expenditure. So then can you really take those arguments, and also from international commentaries, relying on provisions which are based on a specific methodology, specific law, and which has a scientific basis for proving those kind of provisions? Ideally, those kind of provisions could be, have a larger weightage for allowance in the year of creation itself, when you compare it with a provision which is more basis management estimates. So I'm guessing, and I think, when we discuss with most of our clients in the sector as well, everyone is pretty eager to have some kind of guidance on the treatment for these kind of provisions, because these are something which are mandated by law, and those numbers will be quite big for the banking and insurance industry. So I think all in all, there could be a potential argument to claim them, but obviously, we look forward for some guidance coming in soon as a part of the overall corporate law.
Yeah, I think many of the companies are using the Europe as a base, basically, since it is based on the Dutch system. So many companies are looking at the Europe and they started making a provision. They started taking a call based on that. Anyone, Pratim, would like to add comment on this?
So, thank you so much, Krishna, for giving me the opportunity. So, just taking that ahead, I fully agree that there may be a cabinet decision or detail that will come forward, but for the banking and insurance, what is also to be noted is what type of provisions will be allowed, whether it will only be Dutch or taking the overall global scenario, because a European side has a different aspect where the Asian side has the different aspect. And also, for banking insurance industries, they have said interest will not be allowed, right? So there are few things that has been clarified, few yet to be clarified, but majorly looking to the standards, it feels that the provisions which are for the businesses will definitely or should definitely will be allowed, and we hope to get some more clarity on that. So thank you so much.
Yeah, Manoj.
Yeah, just to add here, we also need to see that, what the law says as of now. So the law says that we need to start with the audited IFRS profit numbers. So if an IFRS position, those, in IFRS position, if those provisions are already been taken care of, and then profit is determined after that, then one can take a view that, those provisions, especially the mandated one, which is deriving force from some, law, should be allowed as a deduction.
Fair enough. Okay, this question to you, Manoj. See, generally when we are talking about the deductions, we're saying, okay, all the business expenditure is only allowed to be deductible. In case of personal expenses, many of the companies generally, particularly in UAE, there will be so many personal expenses which will be incurred by the management or the top management. So those expenses are to be disallowed. But in case the first question is, okay, to what extent they can safeguard to say that, okay, how they can convert these personal expenses into official expenses, and what are the documentation which, if they are to going to make it as a official expenses, what are the documentation they have to maintain?
Well, I will not mince any words, and I will straight away to be the point that, if the expenses are personal in nature, we don't just try and give a color to them as an official expense. So this is not our role as a consultant, number one. Number two is that, when we say the allowability of expense, we see that whether those expenses are wholly and exclusively incurred for business purposes. So that is the key criteria, and for that we need to see the benefit test, that whether, that expenses is giving some benefit to the organization in deriving the revenue. That is the sole criteria. On the documentation side, generally we ask the clients to have a separate bank accounts, for the businesses, have a separate credit card if they are incurring business expenditure. So those are the documents, and of course the agreements are also important. For example, in a scenario where a premises is used for business purposes and personal purposes also, in those cases the agreements would be very important, which clearly specify that which area is used for business purpose, which area is used for personal purposes. And the benefit test is the key, which will derive whether the expenses are allowable or not.
You see, in particular, I'm talking about the travel expenditure, where in UAE, most of the sole proprietorship. So currently, they might be passing all their travel expenditure straight into the books of account, they get treated as expenses. So in the future scenario, they have to ensure that, okay, they have to safeguard in such a way that in case if they want to claim it as expenditure, they have to have a proper documentation to claim that expenditure. Or
so in this case, like say sole establishment, you said that we need to see that, whether the owner is also regarded as an employee of the organization or not, and where we have spent this travel expenditure. So for example, a travel expenditure incurred on the family of us, going on a vacation, that is clearly a personal expense. Whereas for an individual who is also deriving salary income, and if he is going out for a business tour, then of course it should be allowed as a business expenditure. But when we say travel, those travels should not be to places like Maldives or to places like Thailand. So all those things we need to see, and in totality, we need to see what is the facts and case.
Okay. See, with regarding to Amit, to you, further question on this. For example, in case it talks about for the customers and the suppliers, there is a reduction of 50% is allowed. How about the potential suppliers, or how about the potential customer? It is not, it's talking about only the customers, whether all the business expenditure, which a company incur for the potential customer or potential supplier, whether they can claim as a deductible expenditure?
Yeah, actually, in the law, when we particularly think about a deduction or study the deduction, what is not provided in the law, we can take the benefit. So apparently I can say, if I can prove or I can justify it's advertisement, or I would say business promotion expenses, yeah, definitely I can claim it. Until, yes, again, if it is not a negative, then I should attempt it to make it positive.
Anyone would like to add more on it?
I think I would agree to that. What really needs to be seen is whether one is, how you're kind of accounting for those, what kind of documentations you're maintaining. I think that will have a larger emphasis now going forward, and what is the intent of that business development expenses, expenses for marketing, and if those are the kind of expenses we are looking at, ideally, it should be kind of allowable, because that's not really an expense you are making for your existing customers to, which would be in relation to the existing business you have. So that's where I think a very thin line. Largely you'll have to kind of focus on what is the intent, whether it's properly documented. I think that's going to be the more emphasis area going forward for businesses.
Thank you. Then Pratik, recently on the ministerial decision, that 126 by 2023, with regarding to the interest capping rules. So the interest capping rules is one of the main thing which is going to hit many of the business over here. Basically, most of the businesses, they have taken quite a lot sum of money with, for their capital expansion, or might be for some other thing. So now how it is going to work on the interest capitalization rule, then how the computation work, and also can you please elaborate to what extent, what type of items will be covered under interest capping rules?
So first of all, I think after this cabinet decision, one thing is sure, that 12 million dirhams is still a big amount for micro SMEs and SMEs. So that segment probably will be out of the scope, because then 12 million dirhams of interest is totally allowed, right? There is no cap. Above 12 million dirhams, the cap is 30%. And yeah, you're correct that, all the mid to large segment corporates will be affected through this. And this 30% is, if you consider it is restricted to 12. So say someone has 100, it will not get 30 million, it will get only 12 million. So it's a huge hit for mid to large corporate. And what is covered is, see, anything that is business related, debt, collateral backed, or trade finance, anything that of sort nature will be allowed in this, and this is covered in the interest definition. So I feel that the major hit is only for the large and mid to large scale, but SMEs will get the benefit of 12 million for sure.
Okay, but in the large company, for the large company in particular, we are talking about, see, the first year when they go for a big borrowing, there will be a huge expenditure initially towards the fees and the arrangement fees. So that will have a big impact for a large, for an organization who is going for it. And also, they are talking about, if they are talking about more than now with the interest rate which is being rising, so the 12 million dirhams is significantly lower.
Very low. Yeah, it is low because, see, we are at the brink where generally the rates are 7-8% now. So compared to 1-3% which was earlier. So it will have a huge hit, and also a lot of difficulties in the initial years of carry forward, right? So carry forward is only 75% will be allowed in the next year. So that is also capped. So how many years will you carry forward that loss? What will be the interest benefit is subject to the calculations, but definitely with the interest hike, this will be a huge impact in the overall industry.
Okay. Manoj, would you like to add anything on this?
Yeah, of course. So interest, when we see the interest aspect, transfer pricing is also an area where we should be looking into, because when there is a related party transactions, then interest can also be increased to that extent, and we need to see that whether any adjustment made by the transfer pricing officer, whether that will fit into this interest capping rules or not. So this is something which is quite complex, and this will be ascertained only during the course of tax audit.
Basically, one more important part when we talk about this interest capping. So as Mr. Prateek has rightly said, there are so many components are there that will be considered as an interest component. So considering, I would say, interest for hire purchase, lease and hire purchase agreement, or where I would say interest expense incurred for the futures options to hedge the interest component, or to cover the risk with respect to the funding or debt instruments. Moreover, it may be split in the balance in the profit and loss account in different expense head. Let's say foreign exchange, any foreign exchange with respect to the interest would also be considered as interest component for this calculation. So as a consultant or from the tax planning perspective, the different accounting heads, expense head must be scrutinized to understand what is the quantum of the interest that we are getting. Okay, 12 million is fine, but 12 million may be appearing in the balance sheet as a one line item. 12 million expense paid for the loan to the bank. But what about other component, which may be appearing in the form of foreign exchange, which may be appearing in the form of fees for arranging the fund. So fees for arranging the fund as a guarantee fee or commitment fee, that also will be a part of the interest expense. So one need to clearly understand and scrutinize to dig out what all costs should be accumulated to figure out this 12 million or 30% of EBITDA.
This question to you, Dipesh. See, in UAE, there are a lot of employees who are all working in one group, and they'll be giving it to the other entities. So in order to get a deduction for the entities which they incur expenditure, what are the safeguards they have to take care to ensure that the deduction is, they can get the deduction?
So very, very interesting question. I think very UAE fact specific deduction and a scenario. Generally what we've seen is, there are organizations where you'll have employees sitting or maybe registered in one entity while they would be kind of, providing their services even to another group entity. So say company A would be kind of having all the visas, but the company B is the one which is actually making the payment of salaries and also utilizing the services of these employees. So the real crux comes in is how do you kind of bucket expenditure for these kind of scenarios. So one is, if company A is really doing an intercompany cross charge or a recoupment from company B for the visa costs on a cost to cost basis, there is a clear indication or a clear question that could be arise, right? Because there is an embedded service also which is given by company A to company B for providing the visas, registration, administrative services, so on and so forth. So the real question comes in is if you are doing a recoupment for these kind of visa costs by company A from company B, there has to be a transfer pricing element coming in, because UAE is a jurisdiction which also applies domestic transfer pricing rules. So therefore, this kind of transactions, though low value adding, from a TP standpoint will have to be kind of benchmark, and appropriate benchmark could have to be recovered. That's one part of argument, but the second part of argument is really to kind of understand why this kind of scenario has happened, what is the intent from a regulatory standpoint, and second is if any kind of costs are not recovered, whether this kind of cost for company A are their real business expenditure in itself or no. So that question also keeps on kind of hanging for company A for deductibility standpoint, because it's not something a real expenditure in their books for their own business. So kind of that's another angle, and maybe kind of subject to a complete non-deduction because it's not something that they are incurring for their own business purposes. So I think it's a very fact-specific analysis, trying to understand what's the real fact pattern, why such kind of scenario, whether mandated by a specific law, you have any kind of regulatory nuances to look at, and then see how the current structure is, whether recovery happening, not happening, if not happening, then whether it's really your business or so, and so on and so forth. So I think it's more a fact specific, but very relevant to UAE fact pattern kind of business structures.
True. Manoj, would you like to add?
Yeah, just to add, I'll give you a very interesting case. So for example, here in this part of the world, we have ICV. And a lot of people, they have incentive to have a higher ICV score, so they keep, employee salary in one entity. So we have seen cases where, a trading entity and manufacturing entity being a part of the same group. Trading entity employs 100 employees and takes the cost of 100 employee salary, whereas the manufacturing entity just has only 4 or 5 employees. So this is a clear case where tax authorities can easily find out a trading company cannot have 100 employees. So all these employee cost deduction, they can simply be disallowed. So one has to be mindful of all these things.
Yeah, true. The same way about the finance people or admin people also. Basically, now currently they'll be working in one company. The visa will be in one company, but they'll be managing multiple companies. So then they have to do the recharge. It depends upon the time in which they work for the different companies.
On this disallowance, particularly disallowance, definitely it is not an employee. They are not an employee who's working for a particular entity. But yes, it can be substantiated that employees being assets or resource of the entity can be deployed to serve other entity, for which cross charge can be done, and considering the transfer pricing aspects, expense can be moved through generating a revenue, and allowability cannot be questioned on that.
Correct. Exactly. Okay, let's come back to the GAAR. This is the GAAR is the buzzword which is going around in the market. Manoj, could you please summarize the provision for the purpose of our members and the dignitaries over here? In what situation GAAR will trigger?
So GAAR is a very strong tool. It's an anti-abuse provision. And if you see the decree law, it's become effective when the decree law was published in the official gazette. So it was published in the official gazette on 10th of October 2022. And now from that day, the GAAR provisions are attracted. So the GAAR provisions are in a way attracted somewhere around 15 months before the actual implementation of the law, because most of the cases, the corporate tax law is applicable starting from 1st January 2024. To attract these provisions, there are twin conditions, one which has to be fulfilled. Number one, that the arrangement should not have a commercial rationale, or they should lack the economic reality. That is one. And secondly, the basic purpose or the main purpose of such an arrangement is to avoid corporate tax. If these two conditions are met, then GAAR provisions are attracted. Just to give you an example, like, for an entity, if it is splitting its revenue in such a way to have 3 entities and then splitting revenues 2.5 million, 2.5 million, 2.5 million each entity to claim a small business relief, this is a clear case where GAAR can be attracted. Or let us say, where permanent establishment risks are there, or where the poem are there. So all these are anti-abuse provisions. They can be mixed with GAAR, and because all these purposes is to basically avoid taxes, reduce refunds, or defer taxes. In all the cases, the GAAR provisions can be attracted.
Dipesh, the question is for you. See, the GAAR provision, the regulation had come on October 2022. So for the first year, before the first year, for the taxpayers, how FTA will practically tax the transaction before the first year. Basically, the corporate tax is going to be effective from 1st June 2023. But many of the companies will be following in 2024. But if there is any GAAR provision, if there is any GAAR violation, from 2022 to 2023, how the FTA will consider whether they will charge, because the corporate tax is not applicable, how they will charge corporate tax on that?
Very good question. I think an classic case of the law having force even beyond the year where you are offering your income to tax, and given that GAAR is the only provision which is say under the current law which says is going to have force right from the day of the official gazette. The question comes is, in a practical scenario, if I have done any kind of restructuring which is subjected to a GAAR, say on the 10th of October itself, and my financial year or my first tax period is starting from 2024, how do I kind of, cover this, or I'm completely outside, the GAAR provisions? From an FTA audit standpoint, if this GAAR provisions are invoked, ideally as per the current commentaries and guidelines as well, the FTA would have clear right to disregard the entire transaction that would have done for the purpose of GAAR or achieving any tax benefit. So in that year, so in the first tax year which starts say on 1st of Jan 2024, and if there's an audit for that financial year 2024, FTA has the right to kind of disregard the entire transaction, disregard any implications or tax benefit that you would have got for the first period, and not only the first period, until and unless you kind of re-characterize or unwind your structure that would have given you a tax benefit. So from an FTA standpoint, that's a clear right they'll have to kind of disregard in every year that you file a return. And it's not a case where, if you are doing any transaction restructuring prior to your tax period, you may have no implications as such. So it's a classic case of the law having a force across years, and FTA as authorities have the right to kind of recharacterize and undoing what you have done to obtain any tax benefit.
Okay, do you aware of any other countries where they apply the GAAR provisions before the implementation similar to this case? Do you aware of any such incidents? So basically the other countries also the same provisions will be there.
Same provisions, but
whether the tax authorities in those countries have invoked the provisions before the implementation, before the this one?
Not that I'm aware of. I'm aware of most of the jurisdictions which are having tax, and GAAR is, introduced subsequently as a global standard to, usually there has been SAR provisions already. GAAR is something which has evolved over the years from, mature jurisdictions.
Okay, fine. Amit, the next question is to you. Whether the tax planning will be covered under the GAAR provision. Basically, tax evasion is not allowed. Okay, whether the tax planning, if they do the restructuring and creating a holding company, so those type of things, or any tax planning, whether it is allowed as per the GAAR provisions, and can you just briefly elaborate on that?
Right. First, let's figure out what is tax planning. Tax planning is basically taking the advantage of a tax law that is available through the legal way, and tax avoidance. I won't say evasion. Tax avoidance is something by taking the advantage through misuse of the provisions. And overall objective, main two objective of GAAR, General Anti-Abuse Rules, is to plug in the loopholes, and secondly to reform the law, tax law. So it is something that journal thinks that as the authority will look into the particular circumstances, particular conditions, they will understand what is going on and what the undue benefits that can be availed on that. So if we talk about particularly taking the advantage of tax law, GAAR should not be applied. In a real-time case, I would say if any entity is there who's operating through mainland and can take the benefit from free zone, through the qualified free zone entity. So from my understanding, there should not be any issue. Reason being, in GAAR talks about the commercial adequacy and the economic reasonability. And when we talk about the qualified free zone entity, they particularly talk about the adequate substance must be there.
Okay.
So when the substance has been fulfilled there, and one can take the benefit with respect to their operation, with respect to their management, and other condition laid down, then there should not be any issue.
Manoj, would you like to add further on this?
Yeah, just to give you an example, let us say there is a free zone entity, there is a mainland entity, and the mainland entity splits part of its entity and create another entity in free zone with the sole objective of taking the corporate tax exemption without having substance.
Yeah.
So this is a clear case of GAAR can be hit, and this is a clear case of a tax avoidance. Whereas this mainland entity, it creates a new entity in a free zone and then gradually transfers the revenues and creates substance. This is the tax planning, and this will not be covered.
Yeah, the substance is the key part. Okay.
Even without adequate substance, benefit will not be available. So there is no point on coming up to the GAAR on this.
Okay. Considering the timeline, let's move on to the exempt entities. Okay. Manoj, this question is to you. A government controlled entity will be exempt from CT if it is carried out mandated activities, right? Is there any clarity on what these mandated activities are? And could you throw some light on what these activity, and if there is something similar to VAT law?
So when we see the government controlled entities, these entities are the ones which, derive force from any decree law or any federal law. And when we say mandated activities, the mandated activities are generally the public service activity. So just to give an example, like, law number 7 of 2019, which talks about Abu Dhabi, agriculture and food safety authority. So this is government mandated activity, and this is government control entity. So there are three conditions. One, 100% should be owned by government. It should carry out the mandated activities. And these government control entities should also be listed in a cabinet decision. So it's not that unless it is listed in a cabinet decision, the exemption will not come.
Okay. So this question is to you, Mr. Pratim. While entries on extractive business has been exempted, earlier even branches of foreign banks were subject to Emirates level taxation, subject to certain conditions. Or foreign banks are taxable under the UAE CT law or exempt?
So that is as per my opinion, the foreign banks that is deriving income here should be taxable, and it will not be exempt under the corporate tax law. But when you talk about extractive business, for them it is very clearly specified that will be out of and that will be exempt. But when it comes to foreign banks, also a lot of things will be checked. It'll be a UAE entity, right? So it'll be a branch here. It having a branch substance, lot of other angles will be covered. But yeah, on a thumb rule, it is applicable that the corporate tax will be applicable and will not be exempt.
Okay.
Yeah, just to add here that, for the banking, since foreign bank, they also pay Emirate level taxes, and corporate tax will also be applicable. So we need to understand whether this Emirate level taxes can be offset against corporate tax and all. So we are still waiting for a detailed guidelines on this, and should be coming soon.
Okay, this will be the last question. Dipesh, to you. What are the registration deadlines for exemptions?
So I think if you ask generally to people about corporate tax, the first thing comes is, registration. We still have time. There's no deadline, given by the law or prescribed by the law for registration. I think exempt entities are the only deviation again to that general, accepted norm that there is no deadline. So at least for the qualifying public entities, benefit entities, there is a deadline which is soon approaching, which is 1st of October 2023. That's the last day on or before which they can really go for that exemption. For other entities which are exempt, for example, qualifying funds, the deadline is a little, further. It's 1st June 2024 by which they can really take the registration. But these are the two only, I think, set of organizations or setups which have been prescribed with a deadline or a so-called sunset for registration. Apart from that, there is no clear guidelines on the registration bit.
Okay. Considering our timeline is already crossed, okay. Thanks a lot for all the panel members. A big round of applause for all the panel members. Thank you for sharing your knowledge.